Good afternoon, everyone. My name's Scott Craig. I'm the National Head of VAT Services for Azets, and I'd like you to welcome you to today's presentation and thank you for joining us today. Our webinar today focuses on post-Brexit trading activities between the UK and Ireland. It's relevant for UK and Irish businesses and businesses from any other country that may be trading in those locations. As I'm sure you know, we now have only 42 days until the UK leaves the EU. And as I speak to you today, the government negotiation teams are in final discussions and attempting to negotiate a trade agreement. Reports of a trade agreement have circulated for the last 3 to 4 weeks, but differences over fishing rights, guarantees, and enforcement of the deal are still present, and they seem to be standing in the way of business clarity. We've reached a point where the business community just wants to know what it needs to do. And if clarity isn't forthcoming, disruption on the 1st of January has been suggested and as being inevitable. Azets and Eisner Amper are doing all we can to inform and confirm the real-time issues and working with businesses to ensure they're compliant and keep disruption and cost to a minimum. We know the information provided by the government hasn't been practical enough or perhaps detailed enough. Businesses need answers and clarity now, not in December, when there'll be no time to make change or introduce procedures, and by then January supplies will probably have been negotiated and agreed anyway. So with that in mind, our presenters today are going to highlight and explain real-time issues and opportunities associated with customs duty, VAT. They're also going to explain how you could use Ireland as to future-proof your access to EU markets. I'd like to invite the presenters to, I guess, show themselves and kind of come out of the darkness just now, if that's possible. Lucy is going to join us with customs duty and talk about customs duty. Andy Dawbarn is going to cover VAT. And we've got Frank Keane and Philip Slattery are going to talk about why we should use Ireland to future-proof access to EU markets. So that's our group of individuals who are going to speak to you today. The presenters will disappear in a minute, but will join us again at the very end when there's a Q&A session, and they'll be able to answer any questions that you may have. Before I kind of pass over to Lucy to tell us about customs duty, I'd like to invite you to take part in a poll. If you could use the voting buttons, which will spring up on the screen and on your dashboard, and kind of vote to the answer that's most appropriate for your situation. We're kind of looking to find out how your plans for Brexit are progressing. So our question here is, have you taken any continuity or contingency planning for Brexit at this moment in time? The answers, you can choose from one of the following. I've thought about it, but not taken any active steps. I've planned what I intend to do, in which case you're very organised. I'm waiting until nearer the end of transition period. Getting very close to that, you've only got the 42 days to go, and I'm not really sure where to start. So if you wouldn't mind, vote away and let's kind of see where everybody stands at this moment in time. It'd be quite interesting to try and compare this to the polls that we've run earlier on in our Brexit campaigns. In the way through, the vast majority of people had taken no action at all. There was only kind of less than kind of a quarter of the people who attended had taken any action, and a number of people were still waiting, a small amount were still waiting to hear about a deal or expecting a deal to happen. I'm going to give you a few more minutes to get all your votes in. This is where I'm hoping that technology is working well. Okay. So the votes are in, and it looks as if the vast majority of people have either thought about it but not taken any steps, or have actually planned what they intend to do. Now that's quite a shift from 25% of people to kind of almost kind of half of the audience. Most people are not waiting anymore, which is quite right, and there's a few people who are still not very sure where to start. Well, through this presentation, I'm hoping that those who aren't sure where to start will get a good idea of what they need to do and the actions they need to take. Those who are waiting, we would hope you would take some actions and steps straight away. And those who have thought about it but not taken any steps, again, you'll have an action plan to follow. I think without any further ado, what I'll do is I'll hand over to Lucy, and Lucy can start telling you all about the customs duty side of things. Thank you.
Thanks, Scott. My name is Lucy Sutcliffe, as Scott has told you. I'm the National Customs Duty Director for Azets. And really, during this part of the session, I wanted to cover some of the customs changes which we anticipate at the end of the Brexit transition period around what we currently refer to as intra-EU trade and the physical movement of goods across borders in the event of a no deal. There are a lot of different customs considerations that we need to take into account, or businesses certainly should take into account, but in this presentation we're going to focus on Ireland. So the government has already announced some changes, including the reintroduction of customs formalities for goods imported and exported to and from the EU and the UK. So a customs import declaration would need to be rendered for goods imported into the UK, and a customs export declaration would need to be rendered for goods exported to the EU. There may also be supporting documentation which needs to be submitted and retained, including safety and security notifications, health certificates for plants and animals and non-animal origin, pre-notifications for sanitary and photosanitary goods, waybills and customs commercial invoices. But over recent months, the treatment of the movement of goods and the island of Ireland has been of increasing focus. And the Northern Ireland Command Protocol was published, which sets out a solution to avoid a hard border with Ireland. The protocol also introduces the concept of a trader support service, which some of you might be aware of, which will assist businesses to navigate import processes and manage digital import and safety and security declarations. So what do we know, or what does the protocol tell us? Moving on to the next slide. So the protocol introduces a principle of a dual tariff regime, which means that Northern Ireland will remain part of the customs territory of the UK, and it will benefit from unrestricted access for Northern Irish businesses to the rest of the UK internal market. It will also, Northern Ireland will also be subject to the EU's customs rules and a wide range of EU single market rules with regards to goods. Northern Ireland will remain part of the UK's excise system. So for those of you who are involved with or activity involves excise goods, for example, tobacco, alcohol and oils, HM Revenue and Customs will continue to be responsible for the operation and collection of this revenue. And the protocol is split into sections which represents the treatment of the movement of goods based on the supply chain. So in the first section, it covers moving goods from Northern Ireland to Great Britain. HMG, so UK government, wants to facilitate unfettered access for Northern Ireland businesses, including businesses headquartered in Great Britain with operations in Northern Ireland, to the rest of the UK internal market. So the protocol talks about that for goods, no customs declarations would be required, no import customs declarations as goods enter the rest of the UK from Northern Ireland. No safety and security declarations, no tariffs applied to Northern Ireland goods entering the rest of the UK. And that's quite a key point, Northern Ireland goods. So are the goods manufactured in Northern Ireland, or is their origin another origin? No customs checks, no new regulatory checks, and no additional approvals required for placing goods on the market in the rest of the UK. I mentioned very briefly the Trader Support Service, and this is intended to help businesses of all sizes and at no additional cost, we're told. It may be relevant if you move goods from Great Britain and Northern Ireland, or bring goods into Northern Ireland from outside the UK. This service can or is intended to allow businesses to record electronic information on goods movements and will deal with formalities such as import declarations and safety and security information on behalf of the business. It also has some guidance and training access sessions as well. So if we move on to the second section, and this relates to moving goods from Great Britain to Northern Ireland. So for all goods, the following will apply. An entry or declaration or safety and security declaration must be submitted before the goods arrive. No export or exit declaration for goods leaving Great Britain for Northern Ireland, but a declaration may be needed once the goods arrive in Northern Ireland. And if the goods are perceived to be at risk, and the definition of at risk is still yet to be clarified, of being moved onwards to the EU, a tariff may be levied, which will be based on the EU Common External Tariff. There'll also be new requirements on sanitary and photosanitary products moving from Great Britain to Northern Ireland. Ireland will be classed as a single epidemiological area for health, hygiene and food movements. And as such, health and SPS may be required on goods entering or leaving the province. So for example, export health certificates may be required for the movement of animal products and live animals, and photosanitary certificates may be required for movements of plants and plant products. Moving on to the third scenario, so for goods in free circulation in Northern Ireland, moving to Ireland or other EU member states, this means there's essentially no substantive change for the movement of goods. So we're expecting no customs checks, paperwork or additional requirements, no tariffs or quotas applicable or checks on the rules of origin, no imposition of barriers for EU member states on goods in free circulation and intended for the single market in Northern Ireland, and no differentiation of Northern Ireland goods by EU member states. And the fourth category is goods moving from Northern Ireland to the rest of the world. The process for moving goods between Northern Ireland and non-EU countries will broadly continue as it does now. The government also intends to negotiate trade agreements on behalf of the whole or entire United Kingdom, which means that Northern Ireland will benefit from any free trade agreements or economic partnerships that the UK secures. And while the UK was an EU member state, the UK was automatically part of around 40 trade deals with the EU, well, that the EU had secured with more than 70 countries. 19 of these existing deals, covering 50 countries or territories, have now been rolled over to the UK. And the UK is in negotiations with a further 18 countries, which have existing EU trade deals, including Canada and Mexico. And the UK is also holding talks with the US, Australia and New Zealand. I'm going to pass on now to Andy, who will give you some information about the VAT position.
Thank you, Lucy. Good afternoon, everyone. I'm one of the VAT specialist partners for Azets based in our London office, and I'm going to spend the next few minutes covering the UK VAT issues, which, as you would expect, mirror those Lucy has outlined from a duty perspective. So in terms of the headline issues, during the transition period, the UK has continued to operate under the EU VAT system. However, from the 1st of January next year, and in the absence of any deal to the contrary, as well as the single market and customs areas, the UK will also leave the EU VAT area. This will mean the UK essentially becomes a third country like any other non-EU country for VAT. Inevitably, and there's really no getting away from the fact that this is essentially a bad news story for business, this will result in additional VAT obligations as well as increased admin and documentary requirements, both in terms of goods and services. In relation to goods, the reintroduction of customs formalities for imports will mean a change to the VAT procedures involved. The one bit of good news here is that the UK is introducing the postponed accounting regime for import VAT. This will shift the onus away from payment at the port of entry to the VAT return. The even better news here is that this regime will apply to imports from all over the world, not just from the remaining EU member states. Just a quick practical observation here. We've had a number of queries from clients who are not established businesses in the UK wanting confirmation that they will be able to use this postponed accounting regime when it's introduced. The short answer to this is yes, that they will be able to. And I believe that any confusion that's arisen here comes from the HMRC guidance on the matter that states if you're a non-established taxable person, your nominated intermediary will be able to account for the import VAT on your VAT return, on their VAT return, I should say. This highlights a point that because of the emphasis on the VAT return for businesses which are not VAT registered, they are not able to use postponed accounting, and they would be best advised to use an import or a freight agent for this purpose. But if you are VAT registered, whether you are established in the UK or not, you will be able to use the postponed accounting regime, and this is good news. So moving on to look at the Northern Ireland Protocol, which Lucy mentioned, in the context of VAT, the key points here are that firstly, for any trade between the UK and Northern Ireland, we're not expecting any changes to current VAT procedures. However, for trade between the Republic and Northern Ireland, we will see for VAT essentially the hybrid principles of the dual tariff regime, which Lucy outlined in relation to duty, applying to VAT, meaning in practice that movements to and from Northern Ireland will continue to be EU, intra-EU sales and acquisitions from a VAT perspective. One point here is that the protocol will also mean that businesses based in Northern Ireland which sell low levels of goods around the rest of Europe will continue to be able to use a simplification known as the distance selling regime. This applies to the sales of goods, a topic, this is a topic on its own, but essentially means one rate of VAT will apply to these sales, which avoids the need to otherwise register for VAT in multiple locations. Turning finally to look at services, and in the context of the simplifications I mentioned, many of these will disappear for UK-based businesses after transition. An example of this is the mini one-stop shop or MOS regime, which applies to digital sales, so downloads of software, apps or music, for example, electronically. Similar to the distance selling regime I mentioned for goods, MOS allows businesses operating in this digital arena to submit one single VAT return, although this one has multiple VAT rates declared on it. But again, this avoids the need for multiple VAT registrations, which the way the rules work for sales to consumers would be wherever in Europe the products are downloaded. So this removal of the MOS regime is more bad news, I'm afraid, in the context of the UK. And for businesses based outside the EU using the UK for MOS, they will need to register elsewhere in Europe. We're advising a number of clients on establishing their businesses in Europe presently, and clearly for ease of language, but for some other reasons you're about to hear more of, the Republic of Ireland is an ideal location to move your MOS VAT registration from 1st of January next year. So I'm sorry to be the bearer of largely bad news, but there are some solutions out there. And before handing over to my colleagues at Eisner's, we wanted to pose another poll question for you. So, as I've said, VAT and MOS specifically, and tax more generally, is one reason to establish operations in Europe and Ireland perhaps specifically, but there are of course others. So perhaps you could just consider the options given there, and I'll give you a few minutes just to consider what your motivations are for establishing operations in Europe. Right, I hope that's given everybody enough time just to consider that one. Hopefully the answers will appear in a second or two. Right, that's great. Well, obviously a huge response in terms of customer focus. So I'm hoping that will give my colleagues at Eisner something to feed off of in terms of their next session. So with that in mind, I'm going to hand over now to Frank Keane from Eisner, who's going to talk you through some reasons why using Ireland to future-proof access to EU markets is a good idea. Frank, over to you.
Thanks, Andy. Hello, everybody. As Andy said, my name is Frank Keane. I'm one of the partners here in Eisner Amber in Dublin, and I'm joined today by one of my colleagues, Philip Slattery, from our tax team. And we're going to talk just for a short while this afternoon around why use Ireland as future-proofing your access to the EU. I'm going to start with a little bit of an introduction about Eisner Amber Ireland. I'll talk about why companies internationalise. Very interesting to see the results of that poll there. We'll talk a little bit about setting up in Ireland and having a presence here, and what does the compliance landscape look like. And then Philip is going to take you through some more detail around VAT and RCT on a number of case studies that we've worked on with the Azets team over the last year or so. And I suppose before getting started, I'd just like to thank the Azets team for inviting us here to join them on the call today and to meet all of you. So looking at the first topic there around why companies internationalize, and if we go to the next slide, Eisner Amber Ireland is a firm of chartered accountants and tax advisors based primarily out of Dublin. We have a team of about 100. We focus on international trade, you can see, on niche markets. So this is what we do every day. We don't have a huge amount of Irish clients. We spend all of our time working with companies from around the world, helping them do business from Ireland. We're a member of Alineal Global. You'll see the map there where Alineal has presence all around the world. So again, we like to be really connected for solutions anywhere, and that's why we work so closely with the team in the UK. In terms then of the topic for today, companies internationalizing, we did a study a number of years ago. And at the time, we were really interested in why were companies internationalizing. And you can see in the left-hand side there, I've got 4 circles. And at the time, we asked 10 possible reasons, but we categorized them into 4 areas. One was to make money. That's the first of the orange circles there. The second of the orange circles was about acquiring assets, people or talent. And then the last one was for a lot of businesses. It was a brand promise. They wanted to solve the world's problems, so therefore they needed to be international. What was interesting from this heat map, you can see, is that customer focus was the #1 reason as to why companies left their home market. And interestingly, from the results of the poll there, you can see 86% of you now are looking at internationalizing because you want to be close to your customers. So I suppose it was only a few years ago they were the headings. But now when we see what's happening, we see the impact of Brexit. And maybe it's at this point now, if we were to ask all these questions again, some of the reasons people might be internationalizing is because they feel they have to. So it could be a combination of pull factors from customers around the world, or it could be push factor that Brexit is now bringing you to do something that you mightn't previously have considered or wanted to do. But either way, when you do decide to internationalize, you need to look at where am I going to go? So on the next slide, we look at why is it that thousands of businesses from around the world choose Ireland as a base to do business, a base to hire people, perhaps, a base to serve their customers. And there's lots of reasons which our national agency, the IDA, help companies from around the world. And there's loads of reasons as to why companies would pick Ireland. I've circled a few there in the light blue. I've circled in red. I'm going to come back to those in a second. But I've added the dark blue ones as to why UK companies might be choosing Ireland now. And one of the reasons is, and it shouldn't be understated, is the importance of the trade relationship between Ireland and the UK. You know, the geographic proximity of the two nations means we just do a lot of business with each other. The size of the UK market to Ireland, it's just such an important market for us, and we're an important market for the UK. So it's really important that that relationship is working, and it's really important that Brexit works out well for all of us. So Ireland and Irish people and Irish entities and Irish government agencies are all trying to make it work and to make sure that entities from the UK have a smooth business transition if they're going to do any business using Ireland as a base. We're also seeing now some UK companies where they may not have had pan-European trademarks, or they may have done things out of the UK. They're now looking to see should they have some protection for their intellectual property in the EU, and do they need to register for that? And then another reason some companies are setting up in Ireland is to do with GDPR. And GDPR at the moment, the regulations mean that if an entity is communicating and holding customer data across Europe, it can get in trouble with data protection officers and data protection commissioners all around Europe, unless it nominates what it calls a GDPR representative entity. And if you nominate a GDPR representative entity, then you only have to deal with one regulator. And a lot of companies are setting up their GDPR representative entity in Ireland. So if there's any data issues across Europe post-Brexit, they only have to deal with one regulator. But going back to the kind of main reasons as to why people might pick Ireland, and why particularly entities from the UK would pick Ireland, is it's a common law jurisdiction, really similar to what you're used to in the UK. And the second point I wanted to highlight is that kind of Malta to one side, Ireland is the only English-speaking country in the Eurozone. Now, my sister-in-law is married and lives in the UK in Kent, and every time I mention the fact that we're the only English-speaking company left in the EU, my brother-in-law always kind of smiles at that, because he knows my version of English is a little bit different to his. But anyway, hopefully we will get a chance to work with some of you over the coming months, and we won't have any problems on the communication side. On to the next slide then, on the assumption that you are going to do something internationally, on the assumption that you do pick Ireland, what does the compliance landscape look like? So we've kind of plotted across the kind of things you're going to encounter. So the first point might be to decide, do you need a company? Are you going to have a branch? Are you going to have a non-trading establishment? What are you going to actually have in Ireland? But when you make that decision, let's say, for example, here it's a company, everything in Ireland is so similar to what you're used to in the UK. You incorporate a company, you need to have statutory directors, secretary, you need to have a registered office, you need to have a company constitution, and then you need to register with the CRO. So you see at the turn on the middle lane there, file signed a CRO application. And CRO is the company's registration office, which is the Irish version of the Companies House. Similarly, opening bank accounts, you need anti-money laundering information, tax registration, all very similar to what you'd be used to in the UK. And then if you hire somebody, you're into just normal compliance. You'd have monthly payroll. Again, we have a PAYE, PRSI system. We have a few kind of other types of deductions, but primarily it's PAYE, it's PRSI, which is our version of national insurance. If you're trading, then you've got bi-monthly VAT returns. As Andy mentioned, you can use Ireland as a mini one-stop shop. You can file for your VIES registration in Ireland, which means you can trade zero-rated across the EU with registered entities. You can register for your intrastat for trading goods across the EU. So everything, it can be done from Ireland across the EU. And then very similar to the UK, you're going to have an annual return every year. You can have a corporation tax return filed annually. And lastly, then you've got to file statutory financial statements. And in Ireland, we have the same gap. It's either IFRS or FRS 102. And the FRS 102 then would be under the Irish Companies Act. But again, the gap you'd be very, very used to. In Ireland, we have a requirement for audit unless you're audit exempt. So a lot of entities will be audit exempt due to their size. So that's kind of the high level view of Ireland's compliance landscape. And so I think you'll find when you come to Ireland that you'll find it very, very similar to what you're used to in the UK. So moving on then to the next slide, I'm going to hand you over to my colleague, Philip, who's going to talk you through some of the tax highlights of Ireland, what you'd expect, and then get into some detail on the case studies. Over to you, Philip.
Thank you very much, Frank. And thank you to Azets for inviting me along to speak at today's webinar. So first of all, I'm going to look through a few of the tax highlights in Ireland, and then I'll focus a little bit more on certain elements before I go into two case studies looking at RCT and VAT. They say there's two certainties in life, death and taxes. But certainly in Ireland, one of those taxes is correct, and one thing we are certain of is the 12.5% rate when it comes to trading profits and corporate tax. Every year during the budget, this is one of the first sentences that comes out of the Minister for Finance's mouth, that the 12.5% rate is here to stay. This gives certainty to Irish companies and companies looking to come into Ireland and trade what their tax will be in the years going forward. In Ireland, trading dividends can be taxed at 12.5%, where the income is sourced from trading activities of the subsidiary once certain conditions are met, and there's also a credit available for any foreign withholding tax that was paid in the other countries. We have a wide-ranging domestic exemption from withholding tax on repatriation of profits by the way of dividend of interest, where this is paid to a DTA country. Again, this is subject to certain conditions being met. We have a 3-year exemption for certain startup companies to ensure that people can help get the company off the ground before paying larger amounts or higher taxation. We have an extensive double tax treaty network, which will help eliminate or reduce the withholding tax for countries and companies that do their business all over the world. We have employee tax incentives, such as the SAP scheme, which is there to reduce tax on secondees or people who transfer staff into Ireland. This is mostly seen where the likes of larger companies such as Google and Facebook are coming into Ireland to set up. In Ireland, we have developed an onshore tax regime, which is fully compliant with the EU and the OECD guidelines and recommendations in this area. Over the last number of years, the Irish Revenue has spent a lot of time and money to ensure that the Revenue Online System, or ROS, is very user-friendly and can help make sure a lot of your tax compliance and registrations can be covered in one website and in a user-friendly way. We also have a participation exemption, which enables companies in Ireland to be free of capital gains tax when they're selling subsidiary companies, dependent on certain conditions such as shareholding and length of holding the shares are being met. Now moving on, I'll look at a few of these in a little bit more detail. When trying to set up in Ireland, a few considerations have to be there, including residency, trading status, and permanent establishment. When looking to see if a company is resident in Ireland, we look at the directors. Do they have Irish directors? We look at where the board meetings are held. We would normally recommend that any Irish resident company holds at least 4 board meetings a year within Ireland. For people such as UK companies, this could easily be met by just flying into Ireland for the day and holding these board meetings in some of the hotels around Dublin, Cork, or Shannon. This also helps ensure the control and management and the big decisions, such as signing off accounts, are being made within Ireland, and this will help show the residency. With trading status, it's always helpful to have employees on the ground in Ireland if you are trying to set up an Irish company, but you must also ensure these employees have the technical ability to cover off the work that you're doing in Ireland, and that you're not simply having the basic employees in Ireland while all the real work is being done in a country elsewhere, as this could be challenged. Permanent establishment looks at the fixed place of business in which businesses or the enterprise is being wholly or partly carried on. Depending on the business, this can vary. For example, if you're looking at a construction site, if the site is capable of lasting more than 6 months, this would create a permanent establishment. And sometimes you have a salesperson working in Ireland who has the ability to sign off contracts. This may also create a permanent establishment and create a liability to corporations. In Ireland, you also need to consider the likes of IXBRL, which are tagged accounts that must be filed with revenue in conditions with larger companies that meet certain thresholds or looked after by Revenue's Large Cases Division. We all know there's a lot of work being done on the likes of BEPS and profit shifting across the OECD. So these are important to be considered now as well from a transfer pricing and DAC6 point of view to ensure the companies are compliant with intercompany activity. Looking at VAT, there is currently 3 VAT rates in Ireland: 0, 9% and 21. The reduced 9% rate was brought in at the last budget, and this will be in place until 31st of October 2021. The 21% VAT rate is due to go back to 23% from March next year. For companies that are based in Ireland, you will have the ability to claim back VAT on purchases post-Brexit, as long as the purchases are trade related. RCT is one of the newer tax in Ireland. This applies to principal contractors who make payments to subcontractors in the construction, forestry and meat processing industries. The three rates here are 0, 20 and 35. These rates are dependent on how compliant the company is with revenue. If all filings and payments are up to date, revenue will apply the 0%. But if you have a company where there's systematic not filing or they have no history with the Irish revenue, they will be charged 35% until that history is developed. RCT is also a turnover tax. So for some companies, if you're losing 35% of your turnover, this is very likely to be higher than the profit margin you're making on that job, which will mean it is a big incentive to ensure your taxes are filed on time to claim that money back from the Irish revenue. The RCT system is also a fully online system, so that everything is done outside of paper and makes it a lot easier and user-friendly. I will now move on to the first of my two case studies. First up, I'm going to look at RCT, or Relevant Contractors Tax. For this case study, we're looking at a UK roofing firm who's been trading in Ireland for a number of years, but due to the impact of Brexit, they need to change how they're working in Ireland. So they are sending over UK staff and subcontractors for a 4-month period. So will RCT be required here? It could depend on what the roofing firm is doing once the goods get to Ireland. It could vary between if they're simply delivering the goods to a site, RCT may not be required. But if they are installing the roofing on the sites they're going to, that might be enough to bring them in to the RCT threshold. But also, from looking at the previous slides, the fact that there's only a 4-month period here would be unlikely that this company would be deemed a permanent establishment in Ireland, and as a result would be unlikely to have corporate tax implications. And moving on to the second case study. This case study, we have a UK firm who for a number of years have been importing phone covers and accessories from Asia. Traditionally, these came into the EU via the UK, but once the UK leave, they will need to find a new point of entry into the EU, and this could be done in Ireland. So particularly if there is sales contracts in place already, and you're just looking to be future-proofed, VAT registration will be required here, as currently the VAT and customs will be due at point of import when the goods enter Ireland. There is currently legislation going through the Irish Parliament to bring in something similar to what Andy was speaking about earlier, to a postponed accounting, to make sure these can be paid in one lump in the month after all the costs come together. And this will aid the cash flow for the companies as they'll be able to budget a little bit better when they know it's the month after is when the payments will come out. And these will then be able to be reclaimed on their VAT returns, which would be filed bi-monthly in Ireland.
I guess kind of moving on, there's a slide obviously shows the people who were talking today, and if you have any questions or if you've got anything that you want to ask post this webinar, feel free to use those contact details. Please feel free to contact them, and you know, we're here to help. We're here to kind of give you the practical advice you need over the next 42-day period and beyond. I'll also flag up that we have a number of other presentations that we're going to be making over the next kind of few weeks and months. And we have webinar involving the accelerating the world's transition to sustainable energy. There's remote working and opportunity for fraud. More customs duty and VAT is the kind of the last gasp. It's the night before Christmas, essentially, on Thursday, the 10th of December. So if there's still things you're not very sure of, you're more than welcome to join us again. But as I say, I think we're at the point where you kind of need to, if you need answers, you need kind of answers quickly. please get in touch. Please kind of don't be shy and kind of ask us the questions. I'd like to thank once again our speakers, and I'd like to thank you all for attending this webinar, and we kind of really appreciate you kind of joining us, and that effectively brings our webinar to an end. And so all that's left to me to say is thanks again to the speakers, thanks to you, and goodbye.